A chipmaker just reported 92% revenue growth, but Wall Street punished it anyway. This stunning disconnect between fundamental performance and market reaction reveals the complex psychology driving semiconductor sector valuations today. The growth achievement. The company's 92% revenue expansion represents exceptional top-line acceleration in an industry typically characterized by single-digit to mid-teen growth rates. This level of growth outpaces most technology sector peers and suggests either significant market share gains, new product adoption, or favorable pricing dynamics in their key markets. Wall Street's reaction. Despite this impressive revenue performance, investors immediately sold the stock following the earnings announcement, sending shares sharply lower in after-hours trading. The market's punishment of strong earnings growth highlights how investors increasingly prioritize guidance, margins, and capital allocation over historical performance metrics. The profit margin. Question. Analysts quickly noted that while revenues surged 92%, the company's net profit margins actually contracted from prior year levels. This margin compression suggests the company sacrificed profitability to achieve aggressive growth, potentially through aggressive pricing strategies, increased promotional spending, or investments in scaling production capacity. The guidance disappointment. Management's forward guidance for the next quarter suggested a significant deceleration in growth rates compared to the recently reported 92% expansion. Wall Street's negative reaction centered on the implication that this quarter represented a peak growth period, with normalization expected going forward. The supply chain context. The semiconductor industry has experienced unprecedented disruption, and some analysts questioned whether this growth rate was sustainable given broader industry supply constraints normalizing. If the growth came during an artificial supply shortage, investors worry the company may struggle to maintain momentum as competitors increase production capacity. Valuation concerns. The stock had already priced in expectations of sustained high growth, leaving little room for the actual results to surprise positively. Investors who already positioned themselves for 80% plus growth found the 92% result underwhelming relative to the premium valuation the market had assigned to the company. Competitive pressure. Larger, more established chipmakers have begun competing more aggressively in the markets where this company achieved its growth, potentially threatening future market share gains. Analysts expressed concern that the 92% growth rate masks intensifying competitive pressures that could compress margins further in coming quarters. Capital expenditure red flags. The company disclosed significant capital expenditure increases to support future production scaling, which will pressure near-term free cash flow, despite strong revenue growth. Investors reacted negatively to the revelation that substantial earnings reinvestment would be necessary before shareholders could benefit from the growth trajectory. The macro headwind. Broader economic uncertainty has caused investors to reassess risk tolerance, making them increasingly skeptical of growth stories dependent on sustained customer demand. This shift in investor sentiment toward safety-first positioning meant that even exceptional growth couldn't overcome concerns about potential economic deceleration. Analyst downgrades. Multiple research firms initiated coverage with underperform ratings despite the strong results, citing valuation excess and sustainability questions around the growth profile. Analysts specifically highlighted that the stock's price-to-sales multiple remained elevated even after the post-earnings decline. The missed beat reality. While revenues grew 92%, the company actually missed analyst expectations on earnings per share due to higher-than-anticipated operating expenses and tax impacts. This earnings miss, though modest in percentage terms, proved sufficient to trigger systematic selling from algorithmic trading strategies and momentum funds. The investor takeaway. This earnings reaction illustrates how modern equity markets have shifted focus from absolute performance to relative expectations and forward guidance credibility. For investors evaluating semiconductor stocks, the lesson is clear. Exceptional growth matters less than convincing the market that such growth will continue sustainably while preserving profitability and shareholder returns.